Hey, good morning, everybody. Appreciate you taking some time out of your your weekend to listen in on this Coffee with Kirk. Today, we're going to talk about a few different things, kind of a hodgepodge, a bit, nothing too substantial, honestly, um, but just a lot of different topics. And again, questions I'm getting from you, so thank you. As you can imagine, we're 3-4 days out from the election. So I get questions. How's the election going to impact us? Should I sell everything, go to cash? Folks who are Democrats want to sell everything, go to cash if Trump wins. And if people voting for Trump want to sell everything, go to cash if Kamala wins. So we'll actually, I found a pretty decent video on this. And honestly, I really don't know. There's always things that people throw out articles, stuff, how it's going to happen. But this video, I'll show a little bit, pretty much hits on what I kind of think. And the thing is, it really doesn't matter who gets elected. I think my thesis will probably play out, but I do want to continue to update everybody on what's going on with the firm. As I've been talking about, I am going to merge in with Coast Guard Academy classmate of mine, Cale Smith. Cale and I are basically rebranding the company entirely. We're going to be called Bastion Fiduciaries. So the website will be lastbastion.com. And we're kind of keeping it a military focused. We've already hired, we have an Air Force Academy graduate. He retired from the Air Force. He retired from the Air Force, was doing financial planning, went back into the Air Force after 9/11. I did a few more years, made 06, got out, continued on with his financial planning career, sold his financial planning practice, and I guess basically, kind of got bored with retirement. So he's working with us. And he's always been a fee-only fiduciary advisor. So same thought process as us, same kind of structure, everything like that. We've also hired just recently hired an ex-Army officer. So he is going to be our paraplanner. So he'll be doing that. Of course, Cale and I have, ex-Coast Guard. And then we have one other employee who he's not an ex-military, but he worked at the Motley Fool. And he was their lead analyst for several years. So he'll be working on money management. And we'll get you interviews. We'll start bringing all this in, so you get to know these folks. But we're planning on a January 1st transition. But for the most part, nothing's going to change for you. It'll just, the name Picket Fence Financial will turn into Bastion Fiduciaries. We're still going to be at Schwab initially. You're still going to be talking to me. Everything will be exactly the same way that it is. We'd hope to roll out some new programs and have exactly a kind of our final fee structures and processes and everything like that. But, these things take time. So the biggest thing is going to be kind of get everything together, make sure it's working. And then we're going to look at, making the changes to get the firm to where we want to be. I'm definitely going to be leaving Schwab. If you've talked to me about Schwab, I've not been happy with it. I wasn't happy with it when TD finally got bought out by Schwab. That was several years ago. TD kind of remained on its own for a few years until Schwab felt it was ready to pull them into Schwab, which happened last year in 2023. So I wasn't happy, and I've had some bad things happen for clients too. Like the process isn't as good. It's just not as good on the advisor side. If you're on the retail side, Schwab's fine. Schwab's very good. It's, I think the second largest brokerage in the U.S. and might be the first now that they've merged in TD. But, on the institutional side, on the advisory side, I don't know. I'm just not real happy with it. So it's hurt some clients. So that's the biggest thing. So we'll probably be moving on that, but that's still not absolutely official. But we're looking to move over to a platform called Folio FN. Still some little things that we have to get done on that front. Negotiations taking place, but that's sort of where we are moving. Now, if you really are excited to get in and learn about what's going on with the firm and want to start to meet folks, everybody that's part of the teams, Cale has routinely done an investor meeting every year for his clients. And so he decided it was probably a good idea to do that again. He hasn't done it for a couple of years. So if you in December are looking for maybe a quick weekend getaway, take your spouse or loved one down to the Florida Keys. Cale's firm is called Isla Mirada Investment Management. So as you could probably imagine, the meeting is going to be in Isla Mirada, Florida, which is about a third of the way down the Florida Keys. And it's going to be at a place called Papa Joe's. They have a tiki bar, which you can kind of see the tiki bar on the photo here. But we're going to have a presentation at 5:00, and then we'll have dinner after. So you'll get to meet everybody. We're going to put on some presentations just to give you an idea of kind of part of it will be obviously investor meetings with Cale. We'll talk a little bit about what he sees. But it's also going to be a lot about where we're headed as a firm. So if you do want to come down, we'd love to have you. Please just reach out to me with questions. The bad thing about the Keys over the past probably 15 years is I used to love to go down to the Keys. I had an uncle lived in Marathon. And it was always these, mom and pop shops, hotels. And the past 15 years, you've seen more private equity firms come in and start buying these hotels and jacking up the rates. So reach out to me if you're looking for some reasonable places to stay. And the other thing, it's not too far either. If you wanted to maybe stay in Miami and come down for the day and go back up, that's not out of the question either. But anyway, if you have an interest in this, we'd love to have you, and just kind of reach out to me and we'll chat. I'll try to answer any questions you got. Okay. So the first topic I just want to talk about is just mixed signals I'm getting again from the markets. And the past couple coffee with Kirks, I kind of said, look, I think I figured out where we're going. We're going to some slower growth, maybe sort of a deflationary environment. And this is after coming off a year where it's been, okay, it looks like inflation. Oh, it's not inflation. It's actually deflation. Looks like it's rapid growth. No, it's not. It's actually slow growth. So I've been getting just mixed signals all year long. And finally thought I had the view. And then when the Fed cut interest rates in September, kind of everything is getting all messed up again. So there's a couple of things I just want to point out, and I really don't have any answers for you right now, but just want to point out some things that just typically don't happen. So the chart you're looking at right now is a chart that basically shows you what the 10-year Treasury yield does as we're leading up to the first Fed cut, and then what happens after the Fed cut. So when you look at this, if you look at the bottom and you see negative 126 to 114 on the bottom x-axis, or I should say horizontal axis. So 120 minus 126 days before the Federal Reserve cuts, and obviously 114 is 114 days after. So if you kind of look at the dark black line, that is the absolute medium result that we've seen historically before a Federal Reserve cut. And then the shaded gray area is the range of outcomes that we've seen after the Fed cuts. And then the blue line is what we've seen so far in this cutting cycle in 2024. Typically, if you look at this, what you start to see is before the Fed actually cuts the 10-year Treasury, the yields start to come down a little bit. So it means the bond prices themselves go up, whereas the yields come down. And then once the Fed cuts, you end up with an even further decline, or at least a stabilizing of the 10-year Treasury. So things continue to go down or kind of stabilize thereafter. Well, what we've seen here leading up to this Fed cut, pretty normal. 10-year Treasury starts to lose as far as yields. So the yields are coming down, price of bonds going up. But then as soon as the Fed cut, we saw something very weird happen. We've had a very sharp upturn in yields. So yields have been climbing pretty fast. Bond prices have been falling. Never seen it like this before. I mean, sure, you've seen sometimes when the bond yield's gone up a little bit, but nothing like we're seeing right now. So, typically when you're talking about, when you're talking about bonds, bonds are telling two different stories sometimes, or it's the same story just told in a different way. So when bond yields go up, it could be that they expect much higher growth. And because there's going to be higher growth, typically stocks are going to do well in that environment. So the bond yields have to come up to attract investors to invest in those bond yields. Or the other story that bonds often tell is inflation. So when bond yields are going up, that means they're expecting inflation, because investors, when they invest their money in treasuries or any other kind of bond, want to have some protection against inflation. So if you look at this chart, this is just the treasury yield. You can see September 24, really from about, May until September, bond yields coming down. And then the Fed cuts and rates have just jacked up. And they jacked up very fast. And we're going to talk about that in a second. So that was the yields. These are the price of the bond. So you can see, again, there's an inverse relationship between yields and bond prices. So the price of the bond comes down as yield goes up. So treasuries are losing money right now, as all bonds are. But what's interesting to me in this situation is, first off, the US dollar, since the Fed cut, has been gaining strength relative to other currencies. Now, it's not completely unheard of where bond yields will go up and the dollar goes up as well. But it is a little odd if the bond yields are signaling inflation, then usually the dollar goes down. The dollar loses purchasing value. So if the 10 years, or if bonds in general, bond yields were going up because of the fear of inflation, then we'd expect the dollar to go down. That's not happening. If we expected massive growth, so bond yields are going up because they expect growth, the dollar could go up. Usually even there, the dollar is going to come down a little bit, which allows for the growth. But we're not really seeing that. Now, it could be that maybe the bond market's expecting growth, and they're expecting that growth to be in the United States mostly, which could mean that the US dollar would get better, get stronger, right? If it's the US that's getting stronger, then bond yields will still have to go up in order to attract investment, and the dollar would go up just relative to the other currencies if they're not growing. Okay, that makes sense to me. But then you throw in gold. So we're looking at all these different things. And typically what I like to see in an environment is several factors showing me the same story. Right? I always say markets are talking to you. It's sort of like when you have a baby. When you had that baby was communicating with you. Now, it wasn't the language that you were used to. They weren't talking English to you. But they would continue to communicate with you to get their point across. They would start crying. You'd say, all right, are you hungry? Or do you need a diaper change? Or do you have a fever? You'd start to go through these things until the communication stopped. It's kind of the same thing with markets. I'm looking for all these different things to say, yeah, look, this is where it's headed. And like I said, at one point, right before the Fed cut, I was pretty sure we were in deflation camp. And the rest of 2024 has been just confounding me because there's always been different signals coming on. And it looks like we're back to that kind of environment. Because if the dollar was going up, it's really rare for the dollar to go up alongside gold. And that's all that gold has been doing. Now, gold is a very good inflation hedge. So if gold is an inflation hedge and treasury yields are going up, okay, that's still inflation. So that tells me, all right, this is inflation. But then the dollar should be going down. That's not happening. Okay. All right. Gold's an inflation hedge. Gold is also an insurance policy against chaos. So if gold is an insurance policy against chaos, what do treasuries typically do in times of chaos? Well, treasury yields go down, bond prices go up. So usually in times of chaos, gold goes up, bond values go up, yields come down because money runs to safety, which usually means, that the dollar in that kind of situation might also go up. So we've got the dollar and gold could be saying that things are going to get chaotic because the dollar is going up, gold's going up, but bond yields aren't acting that way. Bond yields are doing the opposite. So I'm just not getting congruency on any of these items. Okay, so is it inflation? Is it high growth? Is it chaos? What's the market trend tell me? So we looked at bonds, we looked at dollar, we looked at gold. So let's look at another asset class that kind of tells us what the economy is doing. Commodities. Commodities are a great play for both inflation. They warn you when inflation's coming, but they also warn you when the economy is slowing or picking up steam. If the economy is picking up steam, there's going to be a higher demand for commodities, so prices typically rise, and vice versa. If the economy is slowing, I would expect commodity prices to decline. Now, I apologize, I didn't get the bottom dates on these next couple of slides. So if you look at the second dip for the commodities, the second dip down, or the first dip from the right, that was right before the Fed cut interest rates. So Fed cut interest rates and commodities went up. So that was kind of telling me, hey, we got some inflation coming back. Or high growth, could be both. But since really the past 3 weeks, we've now started to see commodities lose steam again, which would tell me that we're either heading to lower inflation, maybe deflation, and maybe a slowing economy. That's what commodities are saying. But now how does that fit in with, so if commodities are saying low growth, low inflation, how does that fit with the other items? It's not perfectly correlated here. So, if gold was expecting deflation and commodities expecting deflation, they both should be going down. But if gold's going up and commodities coming down, that could be saying, hey, we have some, we've got that insurance policy, right? The chaos coming. That could be it. But then again, the dollar going up would kind of confirm that, but bond yields going up doesn't. So we're not getting that good, sign where the markets are telling me the same story. This is just oil. You can kind of see, again, the second kind of spike down at the bottom, the very bottom. The second one was when the Fed cut rates, and then oil jumped, thinking, hey, all right, the Fed cutting rates is going to cause inflation to spike back up. And I think that's what the market thought. But we've seen it fade since then, right? It's faded back. So that's telling us we're not seeing a lot of growth or a lot of inflation. Now, what has me mostly nervous, so let me jump back up. So basically, I can't make a definitive case here. What's really happening? You would think that some of these would start to line up so you can make a decision on it, but they just really aren't. If it was inflationary, I don't think we'd see this happening with crude oil and commodities. I really just don't. We probably wouldn't see the dollar get stronger like it is unless the other countries, the other currencies are going to see even more rapid inflation than we are. That's the only kind we might see our dollar get stronger in an inflationary environment. Typically doesn't happen though. But what has me worried is bond volatility. And I've talked about this over and over. You're probably tired of hearing me saying this. The bond market is the smart money. The stock market's the stupid money. Bonds are 7 times the value of stocks. So there's a lot more money looking at bonds than stocks. And bonds drive the train. Bonds dictate what eventually happens with stocks. And what we're seeing in bonds right now is just a lot of volatility again. When you start to see this kind of volatility in bonds, when they get really volatile, it should concern you as an investor. This chart basically kind of shows you expected rate cuts. That's the blue line. And then what we call the move index. The move index just is the volatility index for bonds. So right now, looking at that blue line back in 9/24/24, the market overall was expecting about, say, 6 rate cuts of 25 basis points. Right now, the market's only expecting about 3 cuts. So expectation for rate cuts has gone down with the past month, but volatility has gone up. Now, volatility should spike if we expect a lot more cuts, because that's a lot of movement that the Fed is causing on the low end of the bond curve. But we're seeing just the opposite. We're seeing bonds get a lot more volatile. This is just a gross chart of the bond index. And what you typically see with the bond index, or the move index, I should say, really once it gets above, 135, that's when things get a little hectic. Okay, so you can see bond volatility back in 2008, huge volatility. And then things settled out. We had a little spike above that 135 right before COVID. We had it again when bonds lost value back in 2022 into 23. Things settled, and now it's getting back up above that level once again. And the thing is, the move index and the S&P 500 have a pretty good correlation. So in this chart, the white line is the S&P 500, and the blue line is the move index inverted. Okay, so we're basically taking this chart. You can see right now we have a spike going up. We flip it on its inverse, and you can see recently this spike looks like it's going down. So it's just the inverse. So if you start to line these things up over time, if you look at the white line and the blue line, there's a pretty strong correlation that when one is going up, so is the other. So when bonds get more volatile, a lot of times that's pretty good for stocks. You can kind of see that trend when, in this case. So that means when bond volatility goes down, stocks go up. Okay, so remember, it's the inverse for the blue line. But here, when you look at it, it's pretty strong. So the S&P 500 has a strong correlation to the inverse of the MOVE index. So when bond volatility is lower, stocks move forward, they go up, and vice versa. Well, what we have right now is pretty much a pretty wide divergence. We've seen bond volatility really start to climb here recently, but it hasn't impacted the S&P 500. So again, if I believe that bonds are the smart money, then it seems like the S&P might be due for a correction, I would think, unless this time the S&P 500 is the smart money and bonds aren't. I don't know. And when you throw this on top of what we just talked about, getting different signals from commodities, the dollar, bonds, and gold, there's a lot of unknowns right now. Maybe that's election related. I don't know. But it's hard for me to really ping it right now to see what I don't have a strong conviction right now. I'm not really sure. And looking back in time, I'm not finding really any periods that kind of validate what's happening here. That's the weird thing. So, we'll just have to kind of wait and see, honestly. I wanted to update you on something that we talked about a while ago. Now, this could be one reason why we're seeing some volatility in bonds. We talked about the reverse repo market. Now, I'll just briefly get into what it is. It's an operation with the Federal Reserve. Now, typically what you see is not a reverse repurchase market, but just the repurchase market. It's a tool used by the Fed where banks essentially have a lot of collateral. They have a lot of loans on their books, but they need cash. So in a situation where they don't have enough cash in the vaults, but they have lots of loans outstanding, what they do is they give the Federal Reserve some of those loans. They give them some securities, and then the central bank gives them cash. And then the central bank charges an interest rate on that cash. And then these are usually very short-term loans. So it's usually if the cash for a bank falls below the statutory limits or regulatory limits, they'll do this operation, a repurchase. They'll go to the repurchase market. But what we saw, there's also a reverse repurchase market, reverse repo market, which very rarely ever gets used. And it's only a situation where there's too much cash at a bank and they need to kind of offload that and get some sort of interest rate on it. Usually when a bank has too much cash, what do? They loan it for a mortgage, a car loan, things like that, business loans. So they take, they get their cash and they loan it out and make money on it. Well, with COVID, what happened is so many individuals got their COVID payments, the PPO loans, all that good stuff. So they took all this massive amount of cash and put it in their bank. So the banks were just flush with cash and they couldn't loan it out. They couldn't loan it out fast enough. So this reverse repo market became a pretty big thing where at this point, the commercial banks would loan the money to the Federal Reserve and the Federal Reserve would give them collateral. So it was a weird situation where the banks had too much cash for regulatory purposes and not enough collateral. So it's just a reverse of the repurchase market. The banks give the cash to the central banks. Central banks give the collateral, usually in the form of treasuries or government securities, to the commercial bank. And then the bank collects interest from the Fed. And what we end up happening during this COVID period, you can sort of see we got up to about $2.3 trillion at the Fed in the reverse repo. Well, this reverse repo ended up becoming something that was odd, that the reverse repo was paying about 5.3% to the banks. So the Fed was paying 5.3% to the banks. The banks eventually started investing in T-bills when they could get a higher rate than 5.3% with no additional risk in Treasury bills. And actually, the Fed and the government kind of liked that. They were getting all this money. They were able to go deeply into debt because the banks had $2 trillion that they could, buy T-bills with. So the government was getting funded this way. And we talked about it a while ago. It started to really drain the reverse repo. We went from 2.3 trillion to $872 billion in about a year and a half. And that was all going into treasuries. Well, now the reverse repo's gone down even further. It's down to about $227 billion. The money's just continued to be going out. So my contention at one point was, if this is how the Fed is funding its deficits with T-bills, they have a massive amount of money coming from the reverse repo markets. What happens when this thing runs out? And it looks like it's probably going to be running out here within a month. So now one of the biggest providers of liquidity to the government is going to go away. And jumping back to gold, one reason gold might be doing well is a lot of foreign central banks are purchasing that instead of treasuries. So how is the government going to fund its shortfall? It's going to have to raise interest rates, which could be the reason that the 10-year treasuries are going up right now. There's a fear going on that they might not be able to fully fund with this reverse repo going to zero. That makes a lot of sense. And the MOVE index, or the volatility bonds, has gone up. So we have volatility going up. We have interest rates going up. We've got gold going up because central banks are buying, foreign central banks are buying gold instead of treasuries. So maybe this is it. Maybe this is how some liquidity event happens. Maybe that's what the market's telling us. But there's recently this week, and you can't really read this garbage, I'll just talk about it. But the Fed's getting to the point where they're going to start to normalize their monetary policy. I think they see this in coming too. And they're going to get in front of any kind of liquidity event that might happen. So this is Laura Loomer, who wrote basically recommending what the Fed should do, or Laura Logan, I'm sorry. And what Laura Logan was saying was basically they need to start to slow down the quantitative tightening that the Fed's been undertaking and at least go to neutral. So what is quantitative tightening, quantitative easing? Remember, the Fed can just print money. So what we had for years, this is the Fed's balance sheet. So if you go all the way back to that 2003, and this, if you take that line from 2003 to 2008, you could take that back into the 1990s. The Federal Reserve had about $800 billion on their balance sheet. So they had $800 billion of treasuries on their balance sheet. And then when 2008 hit, the crisis, the Fed literally just printed money out of thin air and bought treasuries. They tried to get money. And the reason the Fed did this was they pulled treasuries from banks. And actually, at that time, they were taking everything. They were taking the toxic mortgage loans, all that stuff. They would take collateral from the banks and give the banks cash. So they liquefied the banks. And this was a massive jump up. You know, we went from $800 billion for decades to over $2 trillion in 2008, 2009. But it's continually been going up. The Fed has continued to print money, buy collateral, and get cash into the economy. You can see that went all the way up, and then at COVID, they went hyperbolic. I thought the move in 08 was so unprecedented to more than double your balance sheet, but then the Fed went and did it again when COVID hit. So you can kind of see what happened. COVID pushed the balance sheet way up. Well, and then what happened? Well, eventually we had inflation, massive inflation. So the Fed has been slowly trying to reduce their balance sheet. So they're reversing it. This is called quantitative tightening. So they're now either selling bonds to the banks and then taking that cash out of the economy, or they're just letting the bonds they have on their books mature, and that money just kind of goes away. So they've been tightening for a while, not as nearly as rapidly as they've expanded their balance sheet, but they have been tightening. Well, now Laura Logan's talking about we should start to slow the QT, at least taking a neutral position. We're not doing quantitative easing, but we're not going to do any more tightening. So she's kind of talking about looking down the road, what they really need to do. And she's saying what we need to do is now, start buying these T-bills. So if you look at the Fed's balance sheet right now, she says it's overloaded with longer-term maturities. Only about 5% of them are in T-bills. But if you look at the market as a whole, 22% of all marketable treasuries right now are T-bills. So her goal is to stop quantitative tightening, and we'll start buying T-bills. So that should help in case this reverse repo thing would create some sort of liquidity crisis. That's what the Fed's saying. And then she says, eventually, knowing that if things got bad and interest rates went back down to 0%, the zero bound like they did in 08, well, the Fed at that point could stop buying T-bills because a lot of people, that the 0% would take care of that. It wouldn't really cost the government anything to issue this debt. And then they could take the money they had T-bills and go out to the longer term, buy longer dated bonds to keep those from going up. So maybe there won't be a crisis. Maybe, maybe the Fed's got this under control. I don't know. We'll see. We need to keep watching the bond volatility and bond yields to see what's really going to happen. Okay, so now I'll talk just a tad about what's happening with the election, right? I get a lot of questions on the election. How's it going to affect markets? All that good stuff. So first, I just want to show a video. Paul Tudor Jones, he was on CNBC recently. He's a hedge fund manager, and he's very good. He's one of these you don't really hear about, but he's kind of legendary within the investing environment. So he was basically asked this question, and I kind of liked his response, and I sort of concur a good deal with what he was saying. So let me just play this for you, and then it's about 10 minutes, and then we'll come back. Okay, I'm going to try it one more time. This thing's, of course, technology. Let me try one last time here. See if we can get this thing rolling. Maybe it's just a bad connection. We'll reconnect. See how it goes. Okay. I'm not gonna have you do that. If you want this video, I'll just email me. I'll email it to you. Basically, what he said was, bottom line is he expects inflation, and he said, I don't care who it is, if it's Harris or Trump. Neither candidate has talked about really reducing spending, although Trump talks about bringing in Elon, and now I think Ron Paul is going to join, and they're going to look at ways to cut the government, which I'm absolutely need to do if we want to really conquer the inflation. Milton Friedman, the economist, said, inflation is always a government phenomenon. So, but he said, look, either way, he broke it down by just the amount of debt that we have and how much our annual deficit is. And it's just, it's just going to happen. And his interest, they said, well, why hasn't it happened? He goes, look, turmoils like this take a long time to get going, but then they really manifest itself in weeks. So it takes years to get to the crisis and then weeks for the crisis to really happen. So he was just talking about focusing on asset classes that do well in more inflationary environments. And he, I don't advocate this, but he says he doesn't have any bonds whatsoever. I think that's a little bit too radical. But I guess if your approach is inflation is going to happen and it's going to happen in a big way, if you want to put all your chips on the table, that will work. So yeah, he is obviously holder of precious metals and commodities and just things that are going to do well in an inflationary environment. It could also be real estate. Stocks will do better than bonds, obviously, in an inflationary environment, although they could struggle mightily in the shorter term. So that's basically what he said. He did a much better job of it, but it was very good. It's a 10-minute interview. If you do, maybe what I'll do is I'll just plop it into the chat here. I guess I could do that. And then if you're interested, you can click on it. So I'll put it in the chat. If you have an interest to watch it, go ahead and do that. If you can't get through the chat, email me. I can send it to you. So I've got one other thing I'm just going to talk about quickly, dealing with, and it's kind of a question I get a lot from people too, sort of about the election, but more specifically about Trump's plan for tariffs. So, if you hear everybody, economists talk about tariffs, say it's a horrible idea, it's going to cause prices to go up. It's just absolutely reckless idea in their mind. But, it could be or it might not be. Now, if you go back to the 1930s, the Smoot-Hawley tariffs were a horrible idea. And what you had in that situation was every country affected in the Depression, which basically everyone, they all instituted tariffs to protect their jobs for people. Now, if everybody's increasing tariffs, then you do have a big problem, because they took a situation that was bad. The stock market crashed. It was frothy. The markets were frothy. They came back down. They were way ahead of itself. But then it was the governments that really turned it into depression. One of the things was the Smoot-Hawley tariffs, because it created a situation where global trade just plummeted. And when that happened, when you top that on top of the issue that you had with the stock market crashing and it turned into a banking crisis, and then you throw on top of that world trade collapsing, well, at that point, you really had a situation that they'd never seen before. Well, right now, if you look at actual tariffs, you're going to find that we may have free trade here in the U.S., but we don't have fair trade. And I'll show you this in a second. But essentially, most of the other countries have much higher tariffs on us than we have on them, substantially. Now, that could be good in a way. Maybe it does keep prices a little bit cheaper for us, but it also really hurts our economy, our internal economy, our jobs. This chart you're looking at, if you remember the old Ross Perot 1992 campaign, said that NAFTA would end up creating a giant sucking sound of jobs leaving the United States. And guess what? Ross was right. You look at this chart, this is the number of in millions of jobs that have been exported because of essentially NAFTA and more free trade policies. So we've lost about 30 million jobs this way. So that's one of the reasons we might be seeing the wide disparity between the wealthy and not wealthy, that 1%. It's been great for them. They pay less in wages, and which means their profit margins have been higher, or even people who just hold more stocks, companies have been more profitable. So that's been very good for people who hold stocks or own businesses. But if you're somebody where I grew up in Flint, Michigan, those folks saw basically the economy crater. And as a lot of those jobs left for overseas. Now, part of it too, I will say, to be honest, in Flint, having grown up there was, the labor unions didn't help. Labor unions can be great, but they can also be a pain if they get too restrictive. And I saw that firsthand when I worked at AC Sparkplug as an engineering co-op student. And also the local government in the state of Michigan was horrible in that they saw GM and Ford as a piggy bank for decades. So they made a really horrible tax policies. Anyway, but the biggest thing was making it such that it was very easy because of the lower tariffs to send those jobs overseas. We saw the sector, the area get hammered. And the thing is, middle America has been very productive really since the 70s, but they haven't seen their wages keep pace with their productivity. And part of that is because of this outsourcing. So you have people doing as much work, but they're not getting paid as much. So you can kind of understand why people are upset, especially non-college educated blue collar folks. And as I mentioned just a little while ago, we have very low tariffs right now. We're roughly at about, no more than 10%. And in many cases, we're below that. But yet our competitors, our other nations are, laying much higher tariffs on our products. So it makes it very difficult for GM and Ford to ship cars overseas when the tariffs are going to make them cost much more than the internally produced cars. So cars that are built in Germany are much cheaper to Germans than our cars are going to be because of the higher tariffs. And it's even worse with China. Many products, China has a 75% tariff on us. So you could say by Trump raising the tariffs, really all he's doing is creating a fair trade. If you're gonna put a 75% tariff on me, then I'm going to do that to you, and now we're fair. Now it's probably going to hurt both parties, but it will be good for us internally in that we're going to basically buy more American-made cars. Now, that could, in the short term, increase prices. But you can kind of see from this our trade surplus or deficit. So really, all the way back to the 1800s, America was a country that actually exported more than we imported. And then we had basically going off the gold standard in the 70s. And then, we started to see things open up in the 90s with different trade agreements. And we have basically been a deficit country since then, massive deficits. So we are importing substantially more than we export. And what this eventually does is it has gutted the middle class. The other thing that we have to think about is we now have so much of every aspect of our life produced in China. Even things you wouldn't think of, like antibiotics, medicines, even the equipment that we need to do manufacturing is built in China. And so if we got into any kind of war with China, we're done. One of the biggest things that helped us win World War II is the fact that we had just this massive manufacturing capability, and we didn't have any fighting on our soil. So they always said for every tank that Germany destroyed, we could replace that with 10 tanks. Whereas every tank that we destroyed of Germany's, they could replace it with a half a tank. So eventually you're going to win that war. There's just no way around it. So there is a national security effect to have more jobs here in the United States and more manufacturing. Now, could it be inflationary in the short term? Yeah, absolutely, it could be. But if we coupled this move with a reduction in government spending, and if we coupled it with a lower energy cost, so if Trump opens up the energy again so that energy costs come down, you could actually start to see maybe a consistent price, because when you look at the very poor folks out there, the biggest cost of them are groceries and gas, things that let them get to their jobs, and then things that feed their family. And then, of course, housing. If energy goes down, well, obviously their energy costs go down, but their utility costs go down. So their housing costs come down a little bit. And then food is used, every aspect of food uses lots of energy. So if that goes down, food should go down. So you can actually create a situation where they see costs going down there, but then they might see higher costs for some of the imported goods. So your iPhone might cost more. Some of the bigger ticket items might cost more that people typically will do. So it could either reduce the amount that's purchased, or there could be inflation on those aspects. But for the vast majority of people, remember, we've talked about this, 40% of Americans don't have $1,000 in their bank account. So if you can make this sort of a neutral cost maneuver for those people by lowering the cost that they need every day, but increasing the cost for bigger ticket items, but it stays neutral overall. But you create more jobs, more manufacturing jobs, more higher paying jobs here in the United States for those folks. And the ancillary benefit is you've put us in a better position if we had a war with China. Is that worth it or not? And the other thing I'll finish with is really from the start of our nation, Alexander Hamilton set it up. The only income that the government got at that point was from tariffs. I was in the Coast Guard, which originally started as a revenue cutter service in 1790. And its job was to collect tariffs as ships came into the ports. And we kept that going all the way until the 1970s. It was a way that we sort of functioned. And it was also the greatest period from 1790 till 1970s for the United States as far as growth. So there could be some short-term pain with that. Absolutely. Especially if you're higher income folks and you're buying things that are typically bigger ticket items. But you have to start to say, at what point should we start to think about the middle class again and folks that are blue collar? And then for our national security. So I don't think it's all that bad of an idea. Okay, so we're basically at that hour mark. And I don't see any questions that I can answer. I'm not sure. Steve, I'll have to get back to you, or maybe you can email me the questions. I can send you the slides. So appreciate you taking time out of your day to chat with us. And we will talk here in a couple of weeks. But in turn, if you have an interest in coming down to that investor conference, let me know and I'll get you more information. So have a great weekend, everyone.